Hey guys, Shelby Mathis here, and today we're going to be talking about what's the worst that could happen. And we're going to talk about different types of investments or activities that you could be involved in. And then, more importantly, how can I minimize the worst thing that could happen? So let's jump on in. Number one, we're going to talk about the easy peasy type of investing that you could do. It's super simple. It's being a stock investor. And so you just go in there and you invest. Let's say you invest in Microsoft. What's the worst thing that could happen? Microsoft gets sued for $1 gajillion. What's the worst thing that could happen to you? Worst case scenario is you lose the value of your investment. That's it. You're not personally liable for anything that Microsoft does. The other downside is you have stock loss, which is generally capital losses, which you may not be able to use. Capital losses offset capital gain. You get $3,000 a year that you could try to use, but when the stock market corrects and people bail, you oftentimes see these. I see these all day long because I'm a tax guy, but you probably know somebody that lost money in the stock market and they're like, I couldn't even write it off. Well, that's what they're talking about, is that they're carrying forward those losses. You get to use $3,000 a year until it's used up. And in some cases, people are going to need 2 or 3 lifetimes to use up that loss. But the stock investor isn't horribly bad. Now, if that's your activity, you may not be receiving tax benefits from your stock investing because the IRS has a crude view of investing and doesn't allow you to take ordinary necessary expenses against it. So your stock investing either needs to be structured in a business, and I've done videos on how to structure your trading account, or you need to qualify as a trader, which I would never actually put on a return unless I was making my living in the stock market. But the stock market, the worst thing that could happen is really, I lose the investment. That's not too horrible. What about if I buy real estate? So I'm a real estate investor. And so here's the scenario. Let's say that I buy real estate, buy a nice little house, and I make it into a rental. And something bad happens. I'm going to say flames, right? Something bad happens on that property and somebody gets hurt. What's the worst that could happen? They take everything I own. They take everything that I'm going to make. They garnish me for the rest of my life. That's the worst thing that could happen in real estate. And that is why we are so strong on making sure that our clients use some sort of buffer. All we have to do is put a box around that. That could be an LLC. It could be some sort of trust. What we're not going to use for real estate, unless you're flipping or you're a dealer, is a corporation. And there's a lot of tax reasons. But from a liabilities perspective, what's the worst thing that could happen in real estate is it costs you everything you've ever made, and that you have a judgment against you that pushes you into bankruptcy, or that garnishes you until you're gone and then they go after your estate. So I'm not being crass about that. Quite literally, let's say you're a surgeon and you say, hey, you know what, I heard about these inexpensive homes in places like Indianapolis or whatever. So you go, hey, let's buy a nice cash flow property. Great idea. I love it. Until you buy it in your individual name, and then something bad happens there, a discrimination suit, or wrongful termination, or wrongful eviction, or they sue you because they tripped down the stairs, or you got mold, whatever, but they get this massive suit and they're coming after you because you didn't separate it from your individual name. Oh, but I have insurance. Insurance has exclusions all over the place, and insurance also has limits. What this does is it minimizes the target that they're after to just that property. And just like you need air to have fire, you can rob the air out of that box by loaning money from another entity and doing a friendly lien to where there's not even any equity in that home that they're going after. And what it's going to do is it's going to keep you out of trouble because you're going to get quick settlements. If there is a legitimate case, you can actually negotiate on a reasonable basis. But if it's frivolous, it should stop it in its tracks or keep it from ever happening, especially if you follow what we do when we're talking about security through obscurity and anonymous ownership. They won't see what you own. So what we want to do is make sure that there's no reason for them to try to get out of that box, but we want to keep them right in that box. And that's what that does with real estate. Otherwise, you could be looking at serious liability issues. Now, what if you have a side business? Oh, hey, I'm just going to do a side biz, Toby. That couldn't possibly cause many issues. So let me just give you an example. I decide to go out there, get some low-cut Levi's and some tools, and I start my own plumbing business. And I go out there and I pick up a few jobs, and I go into somebody's house, and I'll give you a real-life situation, and I screw up in the type of joint compounds that I use to put together the piping, and I end up flooding the house. And I flood it for multiple days because nobody even knows that the pipe is disconnected and it's come apart and it floods. In this case, the one that I got to see personally was a multi-million-dollar house, and they're on the hook. You're on the hook. You caused the harm. You don't get to say, oh, but it was just a small business. It wasn't making any money. Doesn't matter. Your liability is you personally, unless you do the same thing where we're putting a box around that business. We want to make sure that if anything happens in here, that it stays within those confines. And I don't care if you're a driver for something, if you are doing service with somebody else, you need to think, what is the worst that could happen? Can I make sure that I have some insurance to cover that? Because you always want to be able to have an attorney come in and defend you. Make sure that you have an umbrella policy of some sort, a commercial policy, if you're doing these types of activities. And that can minimize your exposure, but you got to have that box. And that box, again, this might be an Inc., it might be an LLC, it might be an LP, an LLP, an LLLP, you know, right? There's lots of different flavors depending on the state and the type of activity, but we're putting a limited liability entity around it. Now, how about if you just have an IRA, and I'm an investor through an IRA, or better yet, a 401k at your job, and you say, what's the worst that could happen under those circumstances? Again, you're really limited to losing the amount that you put in it. That's what your exposure is. Because in the case of an IRA, you could be personally responsible for the activities inside that IRA, which means if that IRA decides to do real estate, you got to make sure you have that box and put it around it. You can't run an active business inside an IRA, although you could be an investor in a business like owning shares in Microsoft. Same thing, it's like whatever I'm investing in, I just need to look and say, what's the worst thing that could happen? But if I have a traditional IRA, Roth IRA, 401k, 457, and it's just investing in investment, it's just going in and doing publicly traded stuff or bonds, so you're just run-of-the-mill stocks and bonds, you don't really have to worry. The worst thing that could happen is you lose your investment and the investment goes away. But it's not going to creep out and get you unless you cross over and start doing self-directed stuff inside those accounts, in which case then yes, you could personally be on the hook. And again, all you do is look at the activity and say, what's the worst thing that could happen? And then mitigate it. Not that difficult. Pretty much, hey, makes sense, but a lot of people ignore it. Don't be one of those people. Just take a look at it. And if you know anybody that's doing stuff, like especially if you know somebody who's investing inside of retirement accounts or investing in real estate in general, even in their personal names or whatever, you might want to say, hey, what's the worst that could happen?